Welcome to Capital Insights. Thanks so much for your time and being with us. Today I'd like to talk a little bit about Greece. As you probably know, the problems regarding government debt in Greece has reared its ugly head again in 2015. This problem really began about 3 years ago when Greece ran into some financial problems. But at the time, the European Central Bank promised they would do whatever it takes, they would resolve the issue, and they've basically been buying time, if you will, for the last 3 years. But what really forced the issue was that in early January of this year, Greek elections brought in a new set of politicians that really ran on a platform of, number one, wanting to resolve this issue, but number two, wanting to negotiate a deal where full debt repayments weren't made. And basically because it would have meant austerity in Greece for probably a generation to come. Very, very, very socially and politically unacceptable, as you may imagine. Wildly enough, the Greek economy is only about 2% of the entire Eurozone economy. So why is Greece such a big deal? If Greece were gone tomorrow, would it really be that much of an issue? 2% is pocket change in terms of the totality of the European economy. Well, what's most important is that, from our perspective, the Greek drama of the moment has very, very little to almost nothing to do with the real Greek economy. What it has to do with are a number of major issues. Number one, it has to do with the European banking system and the viability and financial integrity of the European banking system. Number two, it has to do with the integrity of the euro and how that euro was constructed. And then number three, as always, outcomes in Greece and outcomes in greater Europe are going to have an impact on our investment decision making and will have an impact on investment outcomes globally. So let's take each of these, because in one sense they're kind of behind the scenes. As you know, when you flip on the TV or you look at financial media, they talk about Greece as if it were some kind of profligate borrower and they shouldn't have borrowed that much money and now they can't pay it back and what are we going to do? Well, that's the least of the problems. The much bigger issues are these other issues. European banking system, number one. Important why? The European banking system is one of the largest holders of European government debt of any global investor. Very, very meaningful holdings. Now, academically, you know that government debt is considered risk-free. And inside the European banking system, bank holdings of European government debt are considered reserves. And reserves in any banking system are the bedrock capital against which loans are made over time. So very, very important, and you want to keep the integrity of those reserves. In January of this year, Lazard, the large New York consulting firm, came out and said that for Greece to remain financially viable, they need a 50% haircut in their debt outstanding. And haircut is a very nice characterization for write-off, debt forgiveness, debt write-down. Again, remember, the European banks are holding Greek debt, and they're also holding Italian debt, French debt, Spanish debt, Portuguese debt, Irish debt, etc., as all part of their reserves. So if Greece were to be afforded a haircut or a write-down in their debt, it's important because since day one, the European banks have not marked their European government bond investments to market value. They've held them at what they bought them for. This is very much like the US banks in the mid part of the last decade when they held all their subprime assets at what they paid for them, not at what they were worth. We're seeing exactly the same thing in Greece and in Europe right now. So if we woke up tomorrow morning and Greece were afforded this 50% write-down or this 50% allowance, if you will, the European banking system would have to write off half of their Greek investments that day, just like that. Could the European banking system handle that? Indeed they could. But eyes are watching throughout Europe, and if Greece were afforded this kind of accommodation, you can bet your bottom dollar that Italy would be right behind them asking for the same treatment, and then so would Spain, and so would Ireland, so would Portugal, and even France. The European banking system can handle a write-down in Greek debt, but it cannot handle a collective write-down in periphery European government debt values. It can't. That is one of the key issues of the current Greek drama. A little bit behind the scenes, but this is the reality of what's going on. And this is why the European Central Bank and Germany want these debts repaid in full, not in part, in full. The second issue, again a little bit behind the scenes and maybe a little bit academic. Let's roll the clock back to 1998 when the euro was originally formed. One of the criticisms of the euro at that time was that there was no one common government guarantor of debt in the European system. Think about the United States as an alternative. The United States, if you will, provides defense spending for all of us in the United States. And the government takes on that liability and the government takes on that burden. Now, of course, the government is the U.S. taxpayers. We know that. But California doesn't have its own defense budget. Oregon doesn't. Neither does Texas. It's the United States. If we went on an infrastructure spending program in the United States and we were going to build bridges and build roads, would all the individual states take on individual debt to build roads in their state? No. The chances are that the U.S. government would issue bonds, the government would guarantee them, and we'd go on an infrastructure building project. In fact, very much like we did in the New Deal, way back when. We see exactly the same structure in China. We see exactly the same structure in Japan. And this is the structure in the United States. But there's only one economy, if you will, worldwide that doesn't have this structure, and that's Europe. There's no common guarantor of government debt. This is important because the European Central Bank is setting interest rates in Europe that apply to all the countries. It's like the Fed in the United States. The interest rates that the Fed sets applies to all of us, not just to some states. So what has played out in Europe over the last X years is that the lowering of interest rates by the central bank has allowed profligate governments like Greece and Italy to borrow until the cows come home at very low rates, the same rates that a country that has a lot of financial integrity like Germany was able to borrow at. So there's very disparate treatment and there's no individualization, as we look at the individual balance sheets of these governments. Is it a flaw in the euro currency? It's debatable, but it's an issue. And why it's important, why these two topics are really important to us as investors, is they're causing global capital to move. And not only global capital, but domestic capital also. It just so happens this year, European stocks are trying to regain the high ground that they achieved last year before they started to fall in the second half of the year. You may remember last year, in July, the euro was 139 relative to the dollar, and it fell all the way to 105 early in 2015. In other words, there was close to a 30% decline in the euro, and one thing that really hurt European securities last year, stocks, even bonds, is they were priced in a declining currency. That hurt. That caused global capital to really start to move, and especially European capital, move out of the banking system, even move out of the markets to places like the United States and places like the US dollar. Well, what we're seeing this year is that although the European stocks are trying to regain higher ground and they haven't gotten back to their highs of 2014, a stock market like Germany, inside of Europe, is at all-time new highs, never seen before, up over 10% this year. Why? If you're an investor in Europe, what you're probably most concerned with is integrity of your capital in a period where viability of the euro and viability of the euro banking system are at least a question. And so what we're seeing is capital gravitating toward the strongest balance sheet in Europe, the strongest government balance sheet in Europe, and that happens to be Germany. Let's talk about a really worst case scenario, probably one that will never happen and probably has a low probability outcome, and that would be that someday the euro is no longer, and we revert back to individual country currencies that existed 20 years ago. Well, again, if you're a European investor, and for some reason you think the music is going to stop and you need to find a chair before that music stops, what chair do you want to be in? You want to be in the German Deutschmark is what you would want to be in. And again, capital isn't moving into stocks in Germany because earnings for these companies are blowing the lights out. Capital isn't moving in because the economy is fantastic in Germany. It's quite the opposite. It's slowing and it's having a tough time. Capital is moving because it's seeking safety. It's seeking government balance sheet safety. It's seeking potential currency safety, etc. So even though The financial media portrays Greece as just another country who's borrowed too much money and they shouldn't have done that, and we're going to have to work out a deal for them to pay that back over time. That's the least of the issues regarding Greece. The key issues are, and this is what we need to watch going forward, and we would suggest to you that as you watch this Greek drama play out ahead, you focus on these issues. The viability of the European banking system, number one, and how they deal with the government debt that they own. Will it work out well? Will it not work out well? Will they have to take write-offs? Will that forestall lending? Very meaningful in terms of economic impacts. The euro is a currency. Will it remain? No one really knows. Will an extreme outcome happen? Again, no one really knows. But in a period where capital is uncertain or scared about currency viability, it's going to move to another currency. And that's exactly what we saw last year with the movement to the US dollar. And then lastly, in somewhat of a conclusion, again, we have spoken about this for probably 6 months or more now, the importance of currencies, the importance of global capital and capital movements in terms of impacting and influencing investment outcomes. This is really the key as we watch what plays out in Greece, not necessarily what you see in the headlines. Is it really all Greek to me, all Greek to you? I hope not, because again, after talking through this, these are the key points to watch as we move forward. On behalf of the entire team at Capital Planning, we very much appreciate your time and being with us. We'll see you again very soon. Thank you so much.